It's Jobs Day, the monthly data release that reveals the state of the labor market. Today, we're looking at data from the latest jobs report for May 2025, one of the most critical pieces of the economic puzzle. A blowout in headline job creation, but under the surface, things might not be as rosy. We'll look at everything from nonfarm payrolls and unemployment trends to jobless claims, average hourly earnings, and labor force participation. At the end, we'll also look at today's trade data to see how effective tariffs have been. Some interesting data there. These numbers tell a story about where the economy stands and where it might be headed. So let's take a look. So, non-farm payrolls, this is the headline number you'll hear reported on the nightly news. This is NFP. We can see that the expectation was 110,000 jobs created. We beat that to by a wide amount, by a large amount, 147,000 jobs created. As you can see, I drew a line where we are currently, where the data came in. You can see that historically, this is not actually that strong of a level in terms of jobs created for a month. But I think the important thing for markets, at least, is, generally speaking, it doesn't really matter as much what the actual number comes in as. It matters much more. Is it higher than expectation? And if it is higher than expectation, how much higher is it? Or is it lower than expectation? Remember, markets price in the future. That's the whole point of the S&P, or the equity market, the Nasdaq, or gold, or oil, or the dollar, or yields. So what really matters is the degree to which a number comes in relative to the expectation. The expectation was 110. We came in well above that at 147,000. So the market is loving this, and it shows strength. Although, as you can see, relative to history, this goes all the way back to the 60s. Relative to history, it's really not that strong of a NFP data print. Here is the unemployment rate. This is, again, that headline number that you'll hear reported on the nightly news. Came in at 4.2, little changed. But again, going a layer below the surface, it's a little bit different. So here is U6. This is unemployed plus marginally attached to the labor force plus part-time for economic reasons. U6 is nearly double the headline unemployment rate. So U6 is 7.8%. This difference, I think, is one of the many sort of under the surface sort of things that we try to look at. U6, I think, is a much more accurate way to reflect the health of the actual labor market. There is also some very interesting news overnight with Microsoft that we'll get to in a second. We'll take a look at the civilian labor force participation rate. So this shows it's just what it sounds like. Out of the people that can work, how many of them are working? Going back to our silent depression kind of thesis, this is one of the many reasons we came up with that. This peaked out at, just like all those other metrics that we've looked at in those various videos. This also peaked out in the early 2000s. We can see that the labor force participation rate peaked out at 67.2%. We are down significantly from that to 62.4. The last time that we were really kind of hanging out around in these numbers were the mid to late 70s, and everyone knows kind of what was going on then. So I think, again, the fact that this has been declining for 25 years is not exactly an indication of a super healthy, super strong labor market. Here's earnings growth. So again, we mentioned last month, the month-over-month data. This is the degree to which earnings went up or down month-over-month, the month-over-month change. Last month, this was very, very strong at 0.4%. And I said be wary of anyone trying to take that 0.4 and extrapolate it out for a year, right? Because that would indicate that wages are growing at like 5% year over year. Well, sure enough, that it was just noise. As you can see with the white line, there is a lot of noise with these month-over-month data prints. So again, just be very careful of anyone trying to sell you a month-over-month data print and extrapolating it out for a year. I think that's dangerous. Here we can see the average hourly earnings on a year-over-year basis. Wages are growing. They're growing at a slower rate than they were. Right now, they're growing at 3.7%. Again, remember CPI inflation is about 2.4. A lot of people will probably dispute that and say actual inflation is much higher. If you've paid auto insurance or gone to the grocery store, you would not probably call inflation 2.4%. So, this could very well be actual negative real wages depending on your inflation basket. But at least using the government's inflation basket, the CPI, this indicates positive real wage gains. Although, like I'd mentioned, this trend is slowing and it has been slowing. Remember, economists look at these numbers, this average hourly earnings growth, this wage growth, they look at it as a headwind. They look at it as something that must be contained. Now, objectively, it is one of the drivers of inflation, but kind of never forget that certain economists of certain camps will look at this as a negative, right? They do not want to see wage growth and look at this as something that needs to be tamed. So I think perspective and context matters when you're listening to a certain economist. Average hours worked per week, again, going under the surface. This is not that strong. So what good is a job, right? That job will get counted in the NFP. What good is that job if you can't work full time? So we can see that average hours worked per week has declined from 35 down to 34.2. This number, going back all the way to the mid 2000s, early 2000s, this number of 34.2 is below historical averages. Here we're looking at continuing claims. This is just what it sounds like, continuing unemployment claims, and we can see that those have been moving up over the past couple quarters, but they have also been moving up pretty rapidly. I'll zoom in much more here so we can see that. Continuing claims seem to be accelerating. This is the number of people on unemployment insurance and continuing to stay on unemployment insurance. The red line is initial claims, which I think show much less of a worrying trend, but continuing claims, made a bottom here in 2022. And generally speaking, you do not see continuing claims make a bottom and then not go nonlinear, right? This corresponds to recessions generally. So maybe you believe that this time is different. And we set a bottom here in 2022. We've been moving higher, and we are not going to go nonlinear where we just go straight up. Unemployment skyrockets. If you believe this time is different, then this time might be different. Generally, though, this time is not different. And I will zoom back in to show kind of what I'm talking about, this acceleration over the past quarter or two. We can see that, here from March, continuing claims went from 1.85 million. We are now at 1.96 million. So, just looking at it, there does appear to be an acceleration in the continuing jobless claims. Initial jobless claims don't seem to be doing that nearly as much, but continuing claims certainly are. The stock market is responding positively. This was a very strong jobs report. Yields rates on the 2-year, the 10-year, and the 30-year rates are also moving higher, right? Bonds are getting sold. And the dollar had been moving higher along with rates, but is giving some of that back, as are rates. I think at one point the 2-year was up like 13 basis points. So, there's been a lot of optimism about the Fed cutting rates. And we can see that there's been a bit of a bull steepener in bonds, while that trend seems to be reversing. And the 2-year is, up significantly, I think, pricing out a good degree of the cuts that have been expected. So I want to mention here, in terms of that under the surface sort of thing, I want to take a look at where the job growth is coming from, and also where this U6 number is coming from. So we talked about long-term unemployed, continuing jobless claims. We talked about the labor force participation rate, which again has been declining for 25 years. The number of people employed for part-time for economic reasons is 4.5 million. Now, this didn't change much month over month, but 4.5 million is a lot. These people would have preferred to work full-time, but were working part-time because their hours had been reduced or they were unable to find a full-time job. The number of people not in the labor force who currently want to be in the labor force, again, unchanged on a month over month basis, but 6 million people. So you already add those two up, and that's 10.5 million people just in these two categories alone. Now let's look to marginally attached. So among those not in the labor force who wanted a job, the number of people marginally attached to the labor force increased by 234,000, a quarter of a million, and now stands at 1.8 million. So you add the three of those three categories up, and you're basically at 12 million people that are not necessarily going to be counted in headline data, but are essentially, in a bad labor market. And then also, I think, the drivers of of employment growth itself is also indicative of some weakness. So in June, social assistance employment continued to trend up. They added 19,000 jobs. So, if the labor market is so strong, why do so many people need social assistance to the point that social assistance employment is growing by 19,000 jobs on a month over month basis? Government employment rose by 73,000. Again, this is not generally something you see in a strong labor market, but this was mainly driven by state and local government. Education, healthcare also added 39,000 jobs. This is similar to the average monthly gain of 43,000 jobs, kind of a rolling average. This was in hospitals, 16,000, and nursing and residential care facilities, 14,000. So to finish on that point before we move on to the trade data, I think that I saw this news overnight. Microsoft came out and announced a huge layoff of American workers. But at the very same time, they're applying for 6,000 H-1B visa requests. H-1B visa is a high-skill work visa. This is not like a farm worker, low-skill sort of visa. This is a much higher skill visa. A lot of tech tech workers are H-1B. And so at the same time, they're laying off 2,300 workers in the state of Washington, including 817 software engineers. They're requesting 6,000 new H-1B visas, right? So it's the same job, it's the same location. The only difference is that Microsoft, the multi-trillion-dollar multinational corporation, can pay them less money. And I think that this, the reaction that I saw from this news yesterday was like universally negative. Like who in America really thinks that this is a good thing? I think that, like we've been talking about, this is just one more thing that I think will be starting to be addressed politically. This is just such a negative. I just don't see how both parties look at this and prefer, the profit margins of a $1 trillion multinational corporation and the stock returns for, a ever smaller number of people that can actually afford to own stocks. I just can't see how those, people keep getting preferred over, just middle class or formerly middle class Americans who are getting screwed a number of different ways. I mean, we went through some of the data here. This is just kind of the cherry on top, in my opinion. And I think that both parties will probably start to address this. When in the late 90s, early 2000s, Democrats were the party of the working class. And I think that we're starting to see like a bit of an reemergence of that sentiment. Clearly, we have kind of populism on the right, different flavors of populism, but this is the sort of thing that everyone just had a negative reaction to. I don't see how anyone other than a Microsoft stockholder, someone who's got millions of dollars in Microsoft stock, or the CEO or the board of directors at Microsoft, I don't see how anyone other than those kind of very, very small groups of people could be in favor of something like this, where you're getting rid of American jobs to pay someone to do the same thing from another country, but the difference being you get to pay them a lot less. I think this is a losing thing that we'll see addressed politically because it's just so kind of egregious, in my opinion. Here's the balance of trade. This has gone parabolic. So the longer term trend here is going back to the 70s and 80s. The balance of trade, the deficit for this goods and services, this deficit has been widening kind of exponentially. You can kind of see that shape there. But what I want to point out is the change recently. So if we kind of zoom into 2017 onwards, there was a huge amount of front running of the tariffs, and we saw this balance of trade blow out to $138 billion per month trade deficit, goods and services. This accounts for our services surplus. Well, after that front running, we can see, the vast majority of that front running, if not all of that front running, has been reduced, and we are back at a level much more kind of reasonable, at least compared to 2021, 2022, 2023, and 2024, of about $71 billion per month trade deficit. But look, this started to increase again. This starting to widen, right? The trade deficit started to widen again. I think there's going to be a lot of noise. We'll probably have to wait a quarter or two, or maybe even three, for this to really find equilibrium. The tariff stuff is still kind of chaotic and still all over the place. But this is one of the areas you can look at if you're trying to objectively evaluate, a policy agenda of the current administration. This is one of those data points that you can just look at a number. I also personally think the DXY, or the dollar index, measured relative to other fiat currencies, I think that's another good objective measure of how successful they are at their stated goals of, reindustrialization and all that kind of thing. I think also, wage growth that we were looking at both in the headline terms here, but also relative to GDP. I think that's another area to look at. I think those three data sources are a good way to object. If you're one of the few people out there that's trying to objectively evaluate the current administration, I would say this data source is one of them. We can see that trade deficit widening again. So there wasn't a ton of super interesting data in this. I would just say there was one thing I noticed here with non-monetary gold. So we talked about this in the current account video that we did. This huge kind of gold imports, right? And that indicated that we might be, headed in the direction of a Mar-a-Lago Accord, a monetary reordering, some kind of big shift in the monetary system, monetary structure globally. And I this did catch my eye earlier that the non-monetary gold exports decreased by $5.5 billion per month. I think that was interesting. Capital goods exports decreased by 1.9 billion. You can see, aircraft, semiconductors. Consumer goods exports increased in terms of exports, and this increased by 1.5 billion. Pharmaceutical preparations was the vast majority of that. Here we can see exports of services was relatively unchanged. Here we'll look at imports real quick. Imports of goods relatively unchanged, kind of overall. But if you look at the components, consumer goods decreased by 4 billion. Pharmaceutical preparations increased by 2.5 billion. Now, if we go back to the exports, you can see that exports of pharmaceutical preparations actually increased by 1.1 billion. I think pharmaceuticals is one of those areas that the administration, from a national security perspective, I think pharmaceuticals is one to keep an eye on for sectoral tariffs and really trying to actively solve the kind of deficit that we have with pharmaceuticals, because that's at the end of the day a national security imperative, in my opinion. Imports of automotive vehicles, parts, and engines increased by 3.4 billion. I think this is another area that the administration really wants to really target hard. The vast majority of that was driven by passenger cars themselves. And then here, if we look at the country by country data, the deficit with Mexico increased by 3.5 billion. The deficit with Ireland, tax haven, a lot of interesting dynamics with Ireland, a lot of hedge funds. There's a whole bunch to say with Ireland, but our deficit with Ireland increased by 2.5 billion, and the deficit with China actually decreased by 5.5 billion. So, whether or not that's success, a month of data doesn't, it'll be, difficult to say, but China is clearly one of their targets on a country by country basis. And so, this might be welcome news that our deficit with them decreased. Now, remember, China is also trying to increase their domestic consumption. They are trying to just as we in America are trying to reorient our economy away from imports, relying on other countries and importing stuff, just as we're trying to restructure towards kind of reindustrialization, China's trying to restructure towards domestic consumption. So we're, trying to balance out. I think both countries got to extremes, right? China went to the extreme with the kind of subsidized export driven dumping, market share at all costs sort of approach. The US went a little too extreme on our side with import everything, rely on everyone else, don't make anything here. And so I think, these two countries are the ones to really watch, our bilateral trade with China. Um, they're a massive economy. And, I think that in order to really restructure both of our economies, the currency, the dollar yuan, is going to be something to keep an eye on. I think ultimately it needs to, because it's a managed currency, I think ultimately there needs to be some sort of explicit agreement between the two countries, because that's really where the issue is. Remember, the currency should be moving, right, to offset imbalances, to adjust, to self adjust for imbalances. The problem is the dollar is broken and can't do that because of Triffin's dilemma and the reserve issues that we have with the reserve currency status. China's currency is broken because it's a managed currency in a by the CCP, and the yuan is not fairly valued, right? It's undervalued, so that they can just continue to make their exports more and more competitive. So again, I think, watch China, watch that dollar yuan. I still believe that the yuan will strengthen versus the dollar as a result, probably, of an explicit currency accord. I've been talking about this for like 9 months. I still think it's likely. We're only about 6 months into the administration. I do not think this trade issue. I do think that they take it seriously, and I don't think this is the end of it. I think that this will be a real effort moving forward for the remainder of their administration. So, I will link both of these reports. The BLS report, if you like very, very granular data, you can see all of it. These BLS reports are very, very detailed. So if you're trying to fall asleep tonight, you need something to read, I would highly recommend the BLS report. It goes on and on and on and on and on. I will link that, and I will also link this BEA report, which goes over the trade data. Again, very strong headline beat on NFP, but once you dig in below the surface, looking at labor force participation rate, looking at the unemployment rate relative to the U6 rate, right? The gap widening between the headline unemployment rate versus kind of the real unemployment rate, in my opinion. Continuing jobless claims, which are heading up, appear to be starting to kind of go nonlinear. You see reports like this out of Microsoft where they're laying off American workers to hire cheaper foreign labor. All these sorts of things, I think, paint a much different picture than what the nightly news might report to you tonight. So hopefully that was helpful, and I will catch you on the next one.